Hello everyone, today I want to tell you about an excellent Canadian company that has outperformed amazing companies like Amazon, Berkshire Hathaway and Walmart over the past 25 years in share price. Market beating stocks just like this one are hard to come by. So today we're going to be showing their returns, the companies they've beat whilst producing those returns, and doing an analysis of the company, finding out what they do and how they've produced such fantastic returns over such a long period of time. At the end, I'm going to be going over this one's valuation, along with the company's own valuation of its share price and planned value per share, which is actually showing massive undervaluation right now. So stick around for that. And as always, if you like this sort of content, then please feel free to maybe leave a like on the video and consider subscribing to the channel. The company I'm talking about is Brookfield Corporation, ticker BNN, which is an alternative asset management company based out of Canada that invests in infrastructure, companies and assets all over the world. Now, Brookfield is focused on building long-term investment and value for its investors through a similar way to Berkshire Hathaway. They seek to do this via high-class capital allocation, investing in companies that they've bought, streamlining and making them more profitable, and then finally producing great cash flows from them. However, unlike Berkshire, they also invest in what we call integral infrastructure and energy. So let's maybe talk through the overall return first, just like I promised. So here we can see the stock and share price performance over the space of about 30 years. Now, this is an annualized return over the space of about 30 years, and they say that their shares have delivered around an 18% return over that same time period. Now, what I find is considerably impressive about this particular company is not only do they put their annualized return, but they compare it against the S&P 500 in their investor presentation. They show that the S&P 500 has produced 11% annualized return over the period of about 30 years, and this stock has actually produced 18% with those dividends reinvested, which is really impressive and not something many companies can actually show and evidence. Some can do it over a short period of time, but not many companies can do it over this extended period. Now, additional to showing that share price and how it's performed against the market, they've also made this comparison against big, amazing companies. So they've actually evidenced their annualized return over a 30, 25 and 20 year period against these impressive companies. And it actually has performed very well. Now, again, this is not something you would normally see from an investment style presentation because most companies simply don't have the numbers or the length of time in an industry to actually evidence their performance in this way. But if we look at the actual screen, so we've got 30, 25 and 20 year period. Brookfield has produced 18% annualized return over 30 years, 19% over 25 years, and 20 years they've produced 16% rate of return, and a total compounded return over that length of time of around 13,873%. Now, if we compare this to the other companies they talk about here, first off, we have Amazon, which is my main share holding in my account. We have no 30-year period to compare it to, mainly because, as they state down here, Amazon has only been public for around 27 years. And its 27-year analysed return and total compounded return are sitting at around 33%, which is obviously a massive outperformance and will likely outperform Brookfield in the 30-year period in 3 years' time. If we take this to the 25-year period though, they've actually outperformed Amazon in this way, and over the last 20 years they've underperformed by a considerable way, about 9% compared to Amazon. Now, when we look at other companies like Louis Vuitton, LVMH, we see outperformance or matching across the board almost. We've got 14% compared to 18% for the 30 years, which is outperformed. 25 years, we've got 19 compared to 13%, which is outperformed, and 16 to 16% in the past 20 years, so it shows matching at the very least. Then we've got Berkshire Hathaway, which is obviously massively well known. Warren Buffett's company, which has produced amazing returns and investments. And we can see that it's outperformed Berkshire considerably over the last 30, 25 and 20 years. So we've got 13% over the past 30 years for Berkshire, outperformed against Brookfield's 18%, 10% for Berkshire against 19%, and 11% for the past 20 years in annualized return, pretty much matching the market here. And then in the past 20 years, Brookfield has produced a higher return by 5% than that. Now, I'm not saying that that Brookfield's better than Berkshire Hathaway. Probably Berkshire's size is actually working against it here because it's harder to grow percentile growth by the size of the companies. And Berkshire Hathaway is considerably larger by Brookfield by a massive margin. But I am saying that the annualized returns that you might be paying for in the future with Brookfield might produce a greater return than the likes of Berkshire Hathaway maybe because of that size. Then we've got Walmart, which is an outperformance across the 30, 25 and 20 years by an even bigger margin than the other companies. And then we've got the market itself, which has produced a 30-year annualized return of 11%, which we saw in that other graph. And we've got the 25-year here, which it massively outperformed 19% to 8%, and the past 20 years, 16% to 11%. Now, again, this is pretty impressive and something we really like to see if we was a shareholder of Brookfield, which I am. Now, past performance doesn't really guarantee anything in the future. However, I would say looking at this sort of indicator and its past performance and how they can evidence it over a 5-year periods and long periods of time, I would say it actually shows how impressively this company allocates capital into different assets and companies to produce a compounded return rate that is very impressive and beats the market, which is obviously what we're trying to do when we invest in individual stocks. Now, just before we talk about Brookfield and what they do to produce this amazing return and see whether this share price around $50 is trading at a good valuation right now, I'd just like to point out that I have around about £4,600 invested in Brookfield. Now, I think it's important to know that going in that I have a stake in the company because I like to be transparent, and I've got to be honest with you guys, I really like the company. So you need to do your own research to decide whether you like this one. I obviously do, but please take that with a pinch of salt when looking at my work and research and decide for yourself. Now, to take it from them, they say they invest in good businesses and work on running those businesses very well to then allocate excess free cash flow wisely into other aspects of their own business. Essentially, they invest in businesses they own, like their asset management business, their insurance business, or any number of other different infrastructure projects that they are doing. They then work to make them profitable and produce great returns, a bit like what they're doing with their Wealth Solutions business at the moment. And then they effectively reallocate that cash and free cash flow they are getting from that business once it's profitable. If they don't think they can produce the returns they want from that company at an excessive rate and can produce better returns elsewhere, they'll siphon off the cash and maybe reinvest it back into their asset business or their energy infrastructure. So any number of other aspects of the business can get free cash flow from other companies within Brookfield Corporation. Now, what companies and their structure they invest in is a bit more complex. So when we talk about this company, we need to actually break down in a bit more detail the different companies that are making up Brookfield. Now, they talk about their cash flows in this as well, but just to start out, in terms of how it's laid out, you've got your Brookfield Asset Management, or BAM, which is a publicly traded company as well, so you can buy into this one. This makes up about 2.5 billion of their 5 billion in free cash flow effectively. Now, they talk about distributable earnings, but essentially BAM itself is producing distributable earnings or free cash flow, which is basically the company's own metric for valuing the return and cash flow that a business is producing to them, how much wealth it is producing and cash it's actually given back to the company to be reinvested elsewhere. So Brookfield Asset Management at the moment is giving 2.5 billion distributable earnings every year back into the business to be reinvested elsewhere. Now, this is their main one, I would say. They own about 75% of BAM, and they still expect this to grow by a considerable margin, I think around 17%. Now, it makes up about half of their overall capital base as well, which is worth noting because if something goes wrong in this aspect of the business, it will likely impact Brookfield Corporation. Then we've got their wealth solutions side of their business, BNT, which is essentially insurance and generally a risk adjusted portfolio for producing returns like any other insurance company. Now, this is actually growing very rapidly, where they're going to see the majority of their growth in free cash flow and distributable earnings in the future. So they say this will likely grow around 33% next quarter in distributable earnings and likely produce around $2 billion compared to the $1.4 billion it is right now. But if we just look at its basis now, this insurance company, an aspect of this big conglomerate, which is Brookfield Corporation, has capital base of about 21 billion and overall distributable earnings or free cash flow of around 1.4 billion. So it still accounts for considerable margin of that 5 billion in free cash flow this company is producing. And then we have the operating businesses, where it gets considerably complicated all over again. Effectively, we're talking about equity, we're talking about property, national infrastructure, and energy or transition is what they call them. So essentially there are four businesses that make up this aspect of the business, the operating businesses they call them. Now that produces a capital overall for the portfolio is around 42 billion of that 155 billion, and they produce around 1.6 billion in distributable earnings. Now, that's through general things like they get paid fees and stuff for operating these businesses. They produce a return from the energy sides of the businesses from contracts they create, a bit like the ones they've just done with Microsoft for a certain amount of energy. So this is national infrastructure, these sides of operating businesses, and is actually makes Brookfield very integral and part of local communities all over the world. So where they set up hydro dams and where they produce a lot of energy, they become almost part of the national grid and build out the infrastructure in different areas. So they become almost integral and make themselves invaluable to local governments and local industries, really. So I think that's quite an understated aspect of their business. It makes them almost indispensable. Whilst these aspects of the business actually produce amazing returns and free cash flow that they can reinvest back into almost anywhere else. So when I talk about this business and its growth, I'm actually talking about the free cash flow, because if we're looking at a business that we want to buy a part of, then maybe we should be looking at the free cash flow it's going to produce in the future, which with Brookfield is quite complicated because they reallocate that cash before we ever see it. So it's not distributed amongst investors and readily accessible. It's redistributed into the businesses that they see fit to, and we don't actually ever see that money. So we have to rely on the company here to tell us how their performance of investment is going. But if we look at where they expect to see this level of growth, they expect around a 17 to 25% CAGR in their distributable earnings, which is effectively their free cash flow. And we can see where this is expected to come from. Now, they're not expecting to see much growth in the operating sides of the business. That sits at around about 2%. So they're not expecting free cash flow growth there. They're expecting a lot of free cash flow growth, around that 33% that we talked about with their insurance side of the business, which we'll maybe talk about a bit more when we talk about the distributable earnings. But essentially, this is the main part of the business that they believe is going to grow the most over the next 5 years or so. Then we have their Brookfield Asset Management, which makes up the majority of their distributable earnings, around 50%, which they expect to grow by about 17% over the same time period. And then we've got two other aspects of the business that we'll talk about a bit more in a bit, which is carried interest and capital allocation. But I just wanted to explain to you guys where this growth is coming from. It's not from the operating sides of the business. Those are slow growth. But we do see growth immensely with the wealth solution aspects of the business in insurance, and we do see it with the asset management BAM. And just quickly on that growth from wealth solutions and from their BAM side of the business, they explain it a little bit here. Now, 4 years ago, their insurance assets with the wealth solutions side of the business sat at 2 billion. It now today sits at 110 billion. So obviously that's a massive amount, and they're now set to generate around 2 billion in profits annually, and the business is only getting started. And they say in the next 5 years they're likely to have around 300 billion in insurance assets. So obviously that growth has slowed down over this period, but it's been massive over this time period. We're talking about 55 times the same amount. So really we're seeing almost a tripling in the next 5 years in their insurance side of the business. So they believe that it's going to grow by about 33% annually from here. Then when we take a look at their scale BAM, so their likelihood of Brookfield Asset Management growing, we see the past performance of this one as well. So it's taken them 25 years to get 1 trillion in assets under management through BAM. And effectively in the next 5 years, they expect to double that to 2 trillion. Now, how likely this is to happen is open to interpretation. The company believes it's possible, and I don't think they'd give this metric out if they didn't believe it was highly likely. But it's worth bearing in mind that generally this growth in terms of the Brookfield Asset Management and in the wealth solution sides of the business is evidenceable in terms of their past performance, because they have produced 1 trillion in assets over 25 years, and they have produced 2 billion from 4 years ago in insurance assets all the way up to 110 billion. So they can maybe do these targets that they've laid out here, and that may be really why it's quite a good idea to invest in this company with that growth and the evidence they can produce in past performance for these aspects of the business. So to understand how these free cash flows have grown in the past, we can maybe get an idea of how helpful this guidance has been in the past in producing their returns. So we can see what they actually have returned compared to what they've promised. So we start off with their year performance, their distributable earnings per share, which has had a CAGR of about 17% since 2023, where they grew it from $3.13 all the way up to $3.67 over the past 12-month period. Take this past performance for distributable earnings to around a 5-year period. They actually have shown it here in this investor presentation. So they say they've achieved their baseline plans from 5 years ago. The 5-year cumulative distributable earnings before realizations projected versus actual. So we've got the actual ones which are here in the green. So that is what they've actually produced. And then we've got what they expected. So this is the graph that they actually showed in terms of what they believed the return would be looking like. So they've got 2 billion in distributable earnings production in 2020, and they were actually underperformed on that year. They then overperformed in 2.7 billion in 2021, and then overachieved again by 3.4 billion in 2022, and then overachieved again in 2023 with 4.1 billion. They've then now underperformed slightly in 2024 with 4.4 billion. And it's just really impressive that they show their old guidance. We don't have to do the maths on this one. We don't have to look about old guidance and see how reliable this company and management team are in producing good guidance for the future, because they've done it for us. Over the past 5 years, they've been pretty spot on with what they actually were likely to produce in terms of return. So they overachieved in 3 of those years and underachieved in 2, but not by much on either scale. So we can see that guidance isn't actually that bad and hasn't been that bad over the past 5 years. What about the return for the future? We know that the past performance and guidance has actually been pretty good, but what are they guiding for the next 5 years? So they say here that if their base plan is achieved, they plan on growing that distributable earnings, or in the sense of free cash flow before realizations, so no capital allocation or carried interest, by around 17%, from around 4.7 billion that they're roughly sitting at now, closer to about 5 billion, to around 10.1 billion by 2029. Expecting that growth to massively bulk out, mainly their wealth solutions side of the business, which is this big blue box here. They do expect growth inside the asset management business, but as we said before, this was sitting at about 33%, whilst this one was sitting at a growth rate of about 17%, while the operating part of the business was only growing around 2%. But they're not quite done there with their growth of their free cash flow and distributable earnings. They then go on to talk about how two other aspects of their business can produce even greater growth for that free cash flow over the space of 5 years. As they say here, reinvestment of excess cash should add around 4 billion of cumulative cash flow over the next 5 years. So this is after realisation. We have realised carried interest at the moment, which is producing an even greater cash flow amount from that before realisations of 4.7 billion. So we're already producing around 400 million in realised carried interest in 2024. The company expects this to grow in the future. So the two aspects that they believe will produce greater returns for them in the future is their realised carried interest, the orange box we have here, and their capital allocation, which is the purple box right here. Now, to explain these two separately, realised carried interest is effectively how this company is managing assets. They produce profits on those assets. That is given to compensation to fund managers. They're also paid in percentages for managing those funds, and that can also produce realised carried interest. So there's lots of aspects of different businesses like private equity and stuff that produce this. Their BAM business produces realised carried interest as well. So they're expecting this to become a bigger aspect of their growth in the future and produce even better cash flows than it already is. Then we've got capital allocation, which is effectively just streamlining and producing higher profitability from operations than otherwise they already can. So they expect to be able to continue to develop the businesses and companies they've already got, to become more streamlined, spend less money, and actually produce greater returns in the future, which would arguably create this capital allocation aspect. But as we can see here, they've guided for their free cash flow growth in the region of 17% all the way up to this 25% CAGR over the next 5 years, which is massively impressive. But now let's talk about the valuation and see whether this company, which has actually produced great returns already so far in the past year, see whether it's trading at a good valuation right now. So firstly, the value of the shares according to Brookfield is considerable. So they value them around $84 per share, which is essentially how they've added up through breaking down different aspects of the business they have stakes in, like Brookfield Asset Management, Wealth Solutions, and the operations side of the business. With the share price currently sitting around $50, then this now says they, in their opinion, offers around about a 40% discount to their planned value. Currently trades at a DE multiple today of around 14 times. That is essentially 14 times free cash flow. And they say over the next 5 years, this is now down to around 9 times price to free cash flow. Now, there's an easy way to check this. The market cap of Brookfield is around $76 billion. And if we divide this by this free cash flow amount, which is producing around about a $5 billion right now over the trailing 12 months, if we take away that carried interest, we get a price to free cash flow sitting closer to 15 than 14. So they include that carried interest, and we can see that number might get up to that 14 times, but at the moment I would say it's getting closer to maybe 15. But it makes little difference to me because 15 or 14 times distributable earnings or price to free cash flow is still incredibly good for a company that is expected to grow that free cash flow annually by around 17 to 25% over the next 5 years. So when I look for companies, I look for free cash flow growth of about 15% annually because it's very hard to do. And this company is guiding for about 17% to around 25%. Whether they do that, I don't know. But this price doesn't look that expensive, especially when you consider the intrinsic value that the company expects to attribute to its shares. So if we take that a bit further, with that $84 intrinsic planned value per share that they say this company is deserving of, with a current share price of about $50 per share, they say they're going to grow that by about 16% CAGR to a planned value per share of $176 at 2029. So in around 5 years, which is obviously very impressive. But one thing I'd like to point out is even if they don't close the gap between this share price and this share price over the next 5 years, it may not matter in terms of the growth you're paying for. So $84 per share and $50 per share is around a difference of about 32%. And if this margin stays the same for this future value per share, then we'll be looking around a value per share of 2029 of about $119 per share, which would still be over double from the current share price. So to me, it may not matter that they close this gap with intrinsic value because the market is simply not pricing in this growth anyway, which I thought was quite significant even if this planned value is never actually realised in share price. Now, taking that a little bit further, they've actually given us what the returns could look like from $50 if we buy at the current share price. So they say their planned value sits at $84 per share in 2024. If that grows to 176 by 2029, that'd be a growth rate CAGR of 16%. But if we buy now at $50 per share, we could see an outperformance of total return by about 29% if the market actually starts valuing these stocks according to how the company values them and gets to $176 per share. So we could be seeing amazing returns or we could still be seeing market beating returns. But either way, I think this share price is still very good. That's obviously why I've been buying now. After this presentation came out, the share price went up considerably from what it was trading at. So I was buying around $44 per share. In the space of about a month, it's gone up to about $50 per share. And I'm still buying because I believe this company is more than worth than that. So thanks for watching. I do appreciate it. And I'll catch you all in the next one.